In this video, we're diving into the wild world of recent market swings, the AI stock rally that's had everyone buzzing, and those sky-high valuations you can't stop talking about. Here's the scoop. Stocks indices have taken a dip to kick off 25, while Treasury yields have climbed. Why the turbulence? A surprisingly strong December's job report has investors rethinking their rate cut fantasies, now just expecting one cut this year. But hey, it's only January. Markets move fast, and staying focused on the big picture is key. So grab your coffee and stick around. We're breaking down what's driving the markets today and all the action around and what it means for you. So let's get into it. First things first, market volatility is normal. Let me say that one more time. Market volatility is totally normal. Think of it as the market's version of mood swings. Remember 24? It also kicked off with a rocky start before turning into a strong rally. Just because we hit a few bumps early doesn't mean the road ahead isn't promising. After two stellar years in the stock market, a little back and forth action is expected. As this chart shows, pullbacks happens all the time, even in years that end with solid gains. Smart long-term investors know how to roll with these swings, using them as opportunities to rebalance and fine-tune their portfolios. Bottom line, don't hit the panic button just because the market dipped a few days in January. Stay cool, stay focused, and keep your eyes on the long game. Next up, let's talk about the Magnificent Seven. And no, that's not J-Lo's next husband. Those superstar tech stocks that have been absolutely crushing it. Since 2023, they've skyrocketed 250%. And if you go back to 2020, they're up a jaw-dropping 500%, thanks to the unstoppable rise of artificial intelligence. But even superheroes have weaknesses. These stocks are sensitive to interest rate changes since their sky-high valuations rely on future earnings. Plus, because they're such a huge part of the market, their outperformance can lead to overconcentration in portfolios, which means you might lose out on some much-needed diversification. The takeaway? Tech stocks are exciting, no doubt about it, but long-term investors should keep an eye on their asset allocation. You want a portfolio that's balanced across multiple sectors, not one that's just riding a single wave. So while you enjoy the tech rally, don't forget to spread the love to the other areas of the market too. Finally, let's talk valuations, because this chart tells a pretty wild story. The S&P 500's price-to-earnings ratio, based on forward estimates, has climbed to 21.5 times earnings. For context, that's getting uncomfortably close to 24.5 times earnings peak during the dot-com bubble. So are we in a bubble? Not exactly. While valuations are high, the current backdrop looks very different. Solid economic growth and a strong job market, and healthy corporate earnings. Plus, many of the tech stocks driving this rally actually have impressive earnings growth, unlike the profitless wonders of those late 90s, pet.com and all that fun stuff. The key takeaway, high valuations don't mean you should bail. They mean it's more important than ever to maintain balance across different sectors and investment styles. Diversification can be your best defense in times like these. So we hope these insights help you un-F your finances a little bit and feel more confident navigating the market's ups and downs. Got questions? Let's chat.